Hello everyone. This is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. Today I want to discuss about estimation of fixed and working capital requirements. How the companies they used to secure different types of capital by using different sources. So after going through this topic, the learner will be able to understand the meaning of fixed and working capital, the difference between fixed and working capital, and what factors influence working capital requirements. So let us start with the introduction. Try to understand what is fixed capital and what is working capital, right? So fixed capital is defined as the assets or investments needed to establish and operate a business, such as property or equipment. Usually, working capital refers to cash or other liquid assets that an organization uses to finance day to day operations such as payroll and bill payments. A business must take capital investments to run effectively. The resources, wealth, or money are required to acquire or equip the tools necessary for them to produce goods or perform services. So, both fixed and operating cash are essential for their business enterprise. By using these two capitals, an entrepreneur can maintain a perfect equilibrium between their assets and liabilities and work toward generating more significant revenue. Fixed assets are the company's earliest and most significant investments and are continuously utilized in production. So, whatever assets that are immovable property which involved in the production process, those assets are known as fixed assets. The money used to purchase long term or fixed assets is referred to as fixed capital. A business's fixed capital comprises the real estate, buildings, furnishings, and tools it utilizes regularly. Additional long term assets invested by the entrepreneur could be cars, houses, and construction equipment. These cannot be liquidated, which means that which cannot be converted into cash that much easily, but they can always be resold and used again. For example, assets are both tangible and long lasting, but nevertheless required for production make up fixed capital. So, fixed capital refers to land, machinery, vehicles, additional equipment, plants, buildings, and other structures. Whereas working capital means the difference between a company's current assets means what you have, that is known as current assets, the properties that can be available, and liabilities, what you owe, is known as working capital. So this number reflects operational effectiveness and the business liquidity and short-term financial stability. Examples: current assets are those a corporation owns that can be dissolved within a year. Current obligations are the past due payments that an organization make in the upcoming fiscal year, in contrast to current liabilities, which include short-term loans, bank overdrafts, creditors, tax provisions, and other similar obligations. Existing assets include inventories, cash on hand, debtors, and so on. So, working capital is used to finance an organization's short term business activity, which is one way that it differs from fixed capital. So, a company might grow with the use of working cash. Without working capital, a business finds it challenging to expand. They may not be able to pay or settle the debt and turn a profit or continue to do so. The key differences between fixed capital and working capital are the basis, fixed and working capital. So let us take the first basis based on the definition. The definition of fixed capital is that putting money into an organization's long term assets. Whereas coming to working capital, the money what the company put in current assets which is for short term. Then coming to the kinds of assets acquired, in case of fixed capital, used to purchase non-current assets for the firm, whereas working capital is used to but the company's current assets. But the basis how liquid it is. See, fixed assets not at all liquid. It means that we cannot easily convert them into cash, whereas working capital extremely liquid. Coming to the conversion, in case of fixed capital, it can't be converted into cash or kind immediately. Whereas the same when you are talking about working capital, it can be easily convertible into cash and in kind immediately. Based on the term, fixed capital serves the business for an extended period, whereas working capital serves the business for a concise period. If you take with reference to accounting period, fixed capital offers benefits more than one accounting period, whereas working capital offers benefits for less than one accounting period. Coming to the objective, fixed capital serves strategy oriented goals. It means strategy it is always meant for long term. So it serves for long term goals, whereas working capital serves operating goals. It means which are for short run gains. Then coming to the consumption, fixed capital does not directly consume the business but serves the business indirectly, whereas business needs working capital to operate. So if you want to run the day-to-day activities effectively, for that we need working capital. Thus, working capital is the amount of money a company needs for day to day operating expenses such as raw materials, employee salaries, and rent, etc. It will tells you how well a company can pay its short term obligations. And working capital is the difference between current assets minus current liabilities. If a company does not have enough working capital, it will be unable to pay financial obligations like accounts payable and may have declared bankruptcy. Thus, ensuring positive working capital in the business is very important. Then, coming to the components of working capital, the first component of working capital is current assets. These are the assets that will be used to pay for the day to day operations of the business. So, current assets include cash, inventory, account receivable, and other short term assets. The second component is current liabilities. So, these are the debts and obligations that need to be paid in the short term. They include things like accounts payable, taxes payable, and wages payable. The third and final component is called cash conversion cycle. Cash conversion cycle. So it refers to the time it takes for a business to convert its raw material into finished products and then sell those products to customers. So thus the component of working capital, the first one is current assets, second current liabilities, and third one is CCC, cash conversion cycle. Importance of working capital. So working capital is important to any organization to ensure timely payment of bills and salaries. So this is one of the most important use of working capital, and this is particularly important with tight cash flow or irregular income streams. And second one, to maintain inventory levels. So this is another key use of working capital is to finance inventory levels. So this is especially important for businesses that operate on just in time delivery models where any interruption in supply can lead to significant losses. Hiring outsourced accounting services from experienced service providers can help manage inventory levels more accurately. So, for that, working capital is essential for any organization. And third one, to take advantage of early payment discount. So, many suppliers offer early payment discounts, which can lead to significant savings for businesses. However, these discounts can only be taken up advantage of it if enough funds are available to make the payments on time. Positive working capital will enable us to take advantage of such discounts. And fourth importance is to support expansion plans. So if a business want to expand, if they want to grow it further, it will need to access additional funds to finance the growth. Working capital can provide this funding through internal accruals or external financing sources such as loans or equity injections. However, business expansion becomes possible only if we give complete attention to the core activities of the business. The next, coming to the purpose of estimation. So, company may need to estimate their working capital in order to develop a business plan, which is a key component of any business plan. It is directly connected with the detailed analysis of financials of the company. So, this analysis include an estimation of working capital needs. Second, secure financing. If you are seeking financing from investors or lenders, they will likely to require an estimation of working capital needs as a part of their due diligence process. And next one is monitor cash flow. So it is important to monitor the business's cash flow closely. As a part of this process, it includes estimating future working capital needs so that one can make adjustments to operations accordingly. Next, make strategic decisions. Whether you are starting your business from scratch or running an established one, you will need to make several strategic decisions in your business. So, estimating your future working capital needs help in making different strategic decisions. And different methods of estimating working capital requirements. So, there are a number of different methods that can be used to estimate working capital requirements. So, which we have furnished in the diagram. The first one is cash flow method, second historical data method, third industry and trade standards method, fourth ratio analysis method, and fifth management judgment method. So let us discuss each. The first one is cash flow method. The cash flow method, it is one of the popular option for estimating working capital requirements. So with this method, The company can forecast future cash flows and use that information to estimate the amount of working capital. The cash flow method simply projects future cash inflows and outflows to determine how much working capital will be required. So, this can be done using financial statements such as income statements and balance sheets. So, this will give us a good idea of how much working capital the company need in the future. Then second method is historical data method. As the name suggests, the historical data method, it uses information from the company's past to estimate future working capital requirements. So based on the past performance, then they use to predict the future requirement of working capital. So this approach is based on the premise that a company's future working capital needs will be similar to its past records. To calculate working capital using this method, first to determine the company's average cash conversion cycle over time. So that CCC is the number of days it takes for a company to convert raw materials into cash. So later estimate company's future working capital needs by multiplying cash conversion cycle by the projected sales. And third method is industry and trade standards method. So this approach can be used to get a general idea of the minimum amount of working capital which is required for a specific industry or trade. So in this method, industry specific data is needed on the average level of inventory, accounts receivables and accounts payable. And this information can be found in surveys or reports from trade associations or other similar organizations. So once gathered this data, estimate companies' working capital requirements by applying these averages to sales volume. So it does not provide a premise estimate. It can help get a general idea of the minimum amount of working capital that may be required for the business. Then fourth method is ratio analysis method. With the ratio analysis method, businesses look at their financial statements and calculate some key financial ratios. The ratios used in the ratio analysis method are the current ratio, quick ratio, and inventory turnover ratio. Even if you own a small business, such financial ratios help to give a snapshot of how well the business is doing and how much working capital is needed. So that can be determined with the help of ratio analysis method. The next one is management judgment method. So this method relies on the knowledge and experience of management to come up with an estimate. To use this method, management first needs to consider the company's past working capital needs. They will then look at any changes that have happened within the company or industry which could impact future working capital requirements. After considering all this, management will come up with an estimate for the company's future working capital needs. And this method is often used because it is quick and easy and does not require sophisticated financial analysis. However, this method can be less accurate than other methods because it is based on subjective judgment rather than the hard data. Then the following methods are used to calculate the amount of working capital requirements in a business. The first one is operating cycle concept. So in this method, the estimates of working capital requirements on the basis of average holding period of current assets, relating them to cost based on company's expectations and experiences. This value of total current assets is known as gross working capital. So, from gross working capital, the expected current liabilities like sundry creditors for raw materials, expenses, etc., deducted to find out what will be the net working capital. And this is most appropriate method of calculating working capital. And second method is current assets holding period method. So this method is based on operating cycle method. Here the working capital requirement equals to gross working capital requirement. And next method is ratio to scale method. The working capital requirements are estimated as a ratio of sales for each component of working capital. Next, ratio of fixed investment method. So in this method, the working capital is estimated as a percentage of fixed investment. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.